Financial markets don't move randomly. A sudden price spike followed by a violent reversal means you're witnessing algorithms hunting for retail stop losses. Over the next 6 minutes, we are going to build a precise step-by-step framework so you can identify and trade these exact liquidity sweeps in gold on the 1-hour timeframe. To execute this correctly, we must follow a strict limit. You will take a maximum of 3 trades per day, 1 for the Asian session, 1 for London, and 1 for New York. Operating with this specific restriction keeps you out of the mid-session chop. It lets you step back, watch the trap trigger, and execute your trade alongside the algorithms, rather than serving as their liquidity. The operational sequence begins the exact second your chosen 1-hour candle opens. Your first step is to draw a horizontal line right at that opening price. With the open marked, drop immediately to the 5-minute timeframe. Look strictly to the left of your opening line and find the most recent unswept high and the most recent unswept low. These 2 points are your active liquidity pools. They represent the exact levels where retail traders have parked their stop-loss orders. This diagram illustrates how price interacts with those pools through a 3-phase cycle: accumulation, manipulation, and distribution. The market consolidates, breaks out aggressively to trigger those resting orders, and then reverses into the true trend. Your job right now is to wait. Do not enter a position. Watch the price action until it spikes past either that 5-minute high or the 5-minute low. This graphic shows exactly how to validate that spike. A true liquidity sweep leaves a long wick with a very small body, indicating immediate rejection. If you see a large, solid candlestick close firmly past your level, that is a breakout. Do not trade it. Entering on a sustained body closure instead of waiting for a clear rejection wick is why retail accounts often lose capital to false moves. Once we see a wick form, we need mathematical confirmation that the manipulation phase has exhausted its momentum. We do this using Fibonacci standard deviation projections. Identify the last 1-minute high and low formed before the candle open. Anchor your Fibonacci tool between these exact points. We want the manipulation wick to push deep, halting precisely on the -2 or -2.5 deviation lines. When the wick hits that zone, the sweep is validated, but a sweep alone is not an entry signal. We now drop to the 1-minute chart to confirm a structural reversal. We need a definitive market structure shift. Watch for price to break above the previous fractal lower high. The faster the market re-enters the trading range, the stronger its intent to reverse. Combining the Fibonacci extension with a structural shift provides a specific set of criteria that limits the need for subjective interpretation at the entry point. With the reversal confirmed, isolate the displacement that caused the market structure shift. Place your limit order at the 50% equilibrium of the fair value gap or order block left behind by that move. Next, set your stop loss. It must go just marginally past the extreme tip of the manipulation wick. Because you are entering at the market's turning point, a failure to reject from this zone suggests the setup is no longer valid. If price trades past the wick extreme, the tight stop minimizes drawdown while keeping the strategy's logic intact. For your target, look back to the opposite side of the 5-minute timeframe. That untouched liquidity pool serves as your baseline objective. To calculate an institutional-grade exit, use this adjusted Fibonacci measurement. Anchor your tool to the recent 1-minute low, but instead of dragging it to the top of the high candle's wick, snap it directly onto the solid body closure. Look at the -2 standard deviation level on this new measurement. That exact coordinate is your primary take profit. Track your time. You are operating within a strict 1-hour window. If your take profit is exceptionally far away and the session candle is nearing its close, exit the position manually. Coupling a wick-based stop-loss with a mathematically snapped profit target creates an asymmetric risk-to-reward profile. Within a single 1-hour window, the market accumulated orders, manipulated price to clear out retail stops, and distributed straight into our target. This graphic contains your final master checklist. Before any capital is risked, verify all 6 steps. 1-hour open marked, 5-minute liquidity identified, wick sweep mathematically confirmed, 1-minute structural shift executed, tight stop placed. Fibonacci body target defined. Open your charting software today. Isolate yesterday's London session. Pick a single 1-hour candle, and test this exact checklist against the raw data. Success in gold trading depends on the discipline to systematically exploit the structural traps left behind by institutional algorithms. You identify a high probability breakout, enter the trade, and set your stop loss. But the price drops just enough to trigger that stop loss, then immediately rockets in the direction you predicted. Price action algorithms hunt these breakout orders to engineer liquidity for larger institutional players. This specific trap is called an inducement. To avoid it, you need a rule-based system to map these manipulations as they form. This allows you to wait for the trap to spring before committing capital. Spotting these levels transforms the way you view the chart, shifting you from the source of market liquidity to a trader who executes alongside institutional flow. Large-scale institutional orders require high volumes of opposing liquidity to fill without causing massive slippage. To find this volume, algorithms target areas where retail orders naturally cluster. This chart shows a common double bottom formation. Retail strategies often teach traders to buy at this gray support zone, which results in a massive pool of sell-side stop losses sitting directly underneath it. A breakout above this trend line triggers buy-stop orders from retail traders. The algorithm uses that buying momentum to fill its own sell orders before price reverses. The patterns most traders are taught to look for, support, resistance, and trend lines, act as markers for the liquidity required to fuel institutional moves. The first step in this framework is isolating the specific trap level, known as the inducement or IDM. To find it, look for a recent break of structure or a change of character. This confirms the institutional trend's direction. Trace the price leg backward from that break. The first valid pullback in that move is your inducement. Mark this level clearly. This initial pullback is designed to trigger your fear of missing out, persuading you to enter the trend too early, right before the algorithm seeks a deeper liquidity sweep. Mapping the chart to find the IDM provides a technical foundation for trading with institutional flow. The system relies on one non-negotiable rule: do not take a trade until the inducement level is grabbed. Most traders fail here because they try to guess the bottom of the pullback. They enter directly into the inducement zone before the market has actually cleared the resting stop losses. You are waiting for a sweep. This occurs when price wicks through the IDM level to trigger stops, followed by an immediate, violent rejection. The size of the sweep is irrelevant. What matters is the specific action of price clearing the trap and then immediately failing to sustain that momentum. Maintaining patience during this phase ensures you only commit capital after the algorithm has finished engineering its liquidity. A common mistake is treating the swept inducement level itself as the place to buy or sell. The inducement is just the signal that the trap has sprung. The real entry zone is created by the institutional reversal that follows the sweep. Look at this manipulation peak. After sweeping liquidity, price leaves a fair value gap, or FVG, moving in the real direction. Wait for a candle close confirming the reversal. Find the newly formed FVG and set a limit order inside that gap. To manage risk, we must avoid placing stop losses too close to the swept inducement level. Algorithms often perform a secondary test of the range. An emotional tight stop will get hunted during these fluctuations, even if your overall directional thesis is correct. Set your stop loss 10 to 20 pips beyond the absolute extreme high or low created by the sweep itself. This structural placement ensures the trade remains active, unless the institutional movement that caused the reversal is breached, aligning your risk with the actual invalidation of the setup. The institutional trade flow is a 4-step sequence. Identify the IDM trap, wait for the sweep, enter at the confirmed fair value gap, and place a structural stop. This sequence transforms a discretionary guess into a repeatable, mechanical execution based on chart structure. To apply this today, open a 15-minute chart for a major pair, identify one recent structure break, and find the valid inducement pullback that preceded it. When you see price approaching that level, trust the rule of the sweep over the impulsive urge to trade the first touch. Mastering this sequence is the definitive line between reacting to retail patterns and trading alongside institutional algorithms.